Welcome, everyone. Thank you all for joining us tonight. I'm here with Dan Valenti, our portfolio manager. And before we begin, just quick note, we're going to cover a good amount of data in the next 15 to 20 minutes. And throughout the presentation, you can ask questions using the chat box at the bottom of the screen. We'll go through all the questions at the end. So tonight's agenda, we're going to start out discussing some of the headwinds that we're experiencing in today's market, including, of course, inflation, rising interest rates, and also, of course, the fact that a lot of people are thinking of, are we going to head for a recession? We'll then review some of the tailwinds that we're experiencing today, including a strong U.S. economy, rent growth and wage growth, along with historically high housing demand and low housing supply. From there, we'll review how and why we are adjusting our investment strategy in light of these market conditions, and then open it up to Q&A. All right, so Dan, why don't you go ahead and start with the first headwind?
Yeah, inflation. It's something you can run from, but you cannot drive from it these days. So we're looking at a chart of the 12-month percentage change in the consumer price index here. And all the way to the right, you can see that it's really ramped up over the course of the last year, so much so that we are at 40-year highs. And so since we haven't seen these levels in 40 years, we thought it might be helpful just to look at how we got here and what it means. So during the 2008 financial crisis and the pandemic, the Fed and government pumped a ton of money into the economy to stimulate demand and economic growth, and they've been very successful at that. However, now what we're seeing is that we have pandemic-related supply chain issues. The Russia invasion of Ukraine and China lockdowns have all disrupted supply, and now demand is outpacing supply, leading to higher prices. Higher food, higher gas, higher shelter is all weighing on consumer disposable income. And so savings are being eroded by higher costs. And if you're not investing today, you're guaranteed to lose money to inflation. So in response to this, what the Fed is doing is they're hiking interest rates. It's going to slow down demand, which takes us to our next headwind, which is rising interest rates. And basically, the high interest rates can curb demand by increasing the cost of borrowing on corporate and consumer debt, which includes mortgages, car loans, credit cards, etc. And if we take mortgages as an example, which have doubled recently from about 3% to about 6%, what that results in and what that means is that if you own or went to purchase a median priced home in the US, your monthly payment just went up by 42%. So Mark, you want to continue on?
Sure. Yeah. Thanks, Dan. So we've got, record high inflation and the Fed's response to it by increasing interest rates quite rapidly. And what that's doing is it's having a very significant impact on housing affordability. And this chart here, shows the steep decline in affordability over the past couple of years, when at the time, I think it's about roughly 45% of households could afford a home. Today, that number is down to 26%. So with the past several years of home appreciation and today's rising interest rates, less and less Americans can afford a home. So while we're all watching, interest rates increasing rapidly, if we zoom out and look back over the long term, this chart shows it quite well. But interest rates today are still near historical lows and well below their long-term averages. So if you see the line in green that's dotted across the screen here, that's the 10-year Treasury. The long-term average is 5.7%. Dan, can you share with us where it most recently is today?
Yeah, 10-year close today about 3.3%.
Okay, so yeah, still a pretty big gap there. And the same with the Fed funds rate in orange, the long-term average 4.7%. Where is that roughly today, Dan?
After the Fed hike, we're expecting that to come in at around 1.6%.
Okay. So again, the takeaway here, interest rates are rising rapidly. We expect that to continue, but all in all, we're still in very low interest rate environment. So Dan, maybe you could share the next headwind.
Yeah, we want to know if we're headed for a recession. We don't really know, but we can look at a few indicators, and one of those happens to be an inverted yield curve. So when the short-term interest rates are higher than long-term interest rates, it can signal an upcoming recession. And as you can see from the chart here, the red box on the right occurred in March. And so if we go back to as far as 1900, the lag between a yield curve inversion and the start of a recession has averaged about 22 months. So essentially what that means is, could there be an upcoming recession? Maybe, but it's probably not imminent. It's kind of a signal that's flashing yellow, not red at the moment. Some other things that we'll continue to watch would be a slowdown in hiring, reduction in job openings, sudden increase in unemployment. Those would be more readily imminent signs of upcoming recession.
Thanks, Dan. Yeah. So again, the question a lot of people are asking is the economy going to go into recession? And we don't know, but we'll tell you this. 8 of the 9 times that the Fed has raised interest rates to fight inflation, the result was a recession. And so not a very great track record. But if we also look at this recent survey, this is just a headline here from May, CEOs noted more than half of them are expecting a recession. So we'll talk more about this in a few minutes, but as Dan noted, there's a bit of a yellow flag, a yellow signal here to watch out for.
Another possible indicator of a recession is just the stock market, right? Stocks recently entered a bear market, dropping over 20% in the S&P. And so what's happening there is they're pricing in a recession into the valuation already.
Okay, thanks, Dan. Yeah, let's shift topics now, talk about some of the positive trends and tailwinds we're experiencing. First, I think it's really important to note the US economy is very strong, and the Fed can fight inflation aggressively with higher rates, largely because the US economy is on solid footing. And so if we look here at the unemployment rate, we are now back down to near all-time lows. And historically, we're well below the long-term average on unemployment, which is about 5.75% going back to about 1948. So a very strong employment market. Next, we're looking at households and consumers. Another indicator of a strong US economy. This chart is showing us that household savings are high. Debt service as a percent of disposable income is historically low. Essentially means that consumers today, relatively speaking, have a very strong balance sheet. So in summary, we don't see a broad slowdown of the economy. The Fed mentioned the same thing in their most recent meeting. We feel that the economy is quite well positioned to deal with higher interest rates.
Another tailwind that we're seeing is solid wage growth. So there are a high number of job openings. There's low employment, and that's pushing wages higher. This kind of should remain the case as there's currently 2 job openings for each person actively seeking a job. And I should note that wages are growing at the highest rate in 20 plus years. And even though it's not enough to keep up with inflation, it's still a positive trend.
Thanks, Dan. Let's shift into real estate and housing. First and foremost, we want to talk about apartment demand. This chart is pretty self-explanatory. it shows the record high demand for apartments that we're experiencing. And it's literally almost off the charts. So in addition to very high demand, the next slide will show us some more trends that we find very favorable. Today, we're facing low housing affordability and extremely short supply of apartments and affordable housing, which is resulting in consistently high rent growth. So you can see this chart, the area in the blue is outlining just how fast rents have been growing. It's pretty much straight up. And so we're not projecting or estimating that this is going to continue for the long term. It's just not sustainable, but we still have a very nice runway to capitalize on these trends, which are expected to continue in the short term. And so just to put it in context, when we're looking at an opportunity, an investment, and we're underwriting it, we're typically looking at low single-digit rent growth, and it has and continues to be well above that. And so there's two points we have here. Realtor.com and apartmentlist.com are projecting 2022 rents to go up between 7 and 9%. That's a nationwide level. Of course, you have to look locally, and it will vary across locations. Some locations that we're invested in are seeing double that still. And so we're essentially assuming that next year we will revert back more to historical levels, and rent growth will still continue, but a much more moderate pace. Now, keep in mind, what we're talking about here is natural market appreciation. It's not taking into account forced appreciation, which would be higher through value add renovations. So I want to pause a second. I want to share my screen and play a short clip of a video that really helps summarize some of these trends that we're seeing that I think everyone would find quite helpful. Let me see here. Share screen. There we go. Can you see this, Dan?
Yep, you're good.
Okay.
A key factor that helped create the housing bubble leading up to the global financial crisis was the pace of construction. Between 2003 and 2010, 2.8 million more housing units were built than the number of households that were formed. There was a housing surplus, and eventually the easy underwriting and speculation forced prices to reset. Comparatively, since 2011, the US has produced fewer housing units, creating a housing shortage. We've effectively run out of available housing units, so it's very difficult to form new households now. That's creating pent-up demand. There's only a 2.1 month supply of houses on the market. In addition, apartment vacancy rates are at a record low 2.4%. As a result, although household formation should be surging, there aren't enough housing units to allow people to move out on their own. And that is driving the housing market. That's driving rising home prices and rents. The situation is very different than it was before the last housing bubble. Rather than an oversupply of housing with very loose underwriting, we have a housing shortage with generally sound underwriting.
Okay. Just get back to the screen here. So I just want to stress a couple things that video just pointed out. If you could go to the next slide, yeah. So to put it into context, we're looking at month supply for inventory. Essentially what this stat means is that if no more homes were listed for sale today, it would take just over 2 months for everything to sell. That is very low. And if you look back to the recession, we have a long way to go before we see a market that is oversupplied, where we had, in 2008, about 10, 11 months supply. And it's leading to apartment vacancy rates, which you can see on the right here, at the lowest levels on record. And we've been saying this for a while now, but continue to say it, apartments across the US are full. So I'm going to shift back and share one more clip, which I think everyone will also find quite helpful, and make sure I don't mess this up. Here we go. Can you see that, Dan?
You're good.
Okay, thanks.
Over the short term, until a lot more housing units are built and housing supply and demand move back toward balance, apartment demand will remain very strong. Apartment rents are much more affordable than home ownership right now. Currently, the average apartment rent is $638 lower than the payment on a median priced home. So even though average apartment rents have gone up about 16% since 2020, or about 8% per year, that's less than half as fast as home payment increases. The pent-up demand for household formation driven by the pandemic, demographics, and housing shortages will continue to keep apartment vacancy rates very low and push rents higher.
Okay. So yeah, it's another view. They're consistently stressing some of these same fundamentals that we're seeing on a regular basis. So let's summarize what we're seeing today. The two main headwinds today that are causing the market to slow down are, of course, inflation and the Fed's response, which is to raise interest rates. So could that tip us into a recession? Potentially. And the average recession lasts historically about 11 months. The most recent recession in 2020, as a result of the onset of the pandemic, was the shortest recession on record, lasted only 3 months. So we feel, today, all things considered, now may not be a bad time for a reset and a recession. And so we're planning for one in the coming 6 to 24 months or so, and we're investing accordingly today. Now, we do feel if there is a recession, it will most likely be mild due to a lot of the positive market fundamentals that we're seeing. Again, to review those again, the economy, very strong, record low unemployment, high consumer savings. We've got wage growth at the highest levels in over 20 years, rent growth continuing across many markets in the US, largely due to a large demand and supply imbalance, demand at all-time highs and supply remaining near all-time lows. All right, so I want to pause and review our investment strategy, how we're adjusting in response to today's market conditions. But let me share just quickly a bit of our history and our evolution as an investment firm. I started investing personally in 2005 with my family, and we focused for 5 years on predominantly single-family distressed investments and small multifamily, a lot of heavy value add fix and flips and rentals. By 2010, we started adding in more commercial real estate investments, recession resistant. We really wanted to diversify. And we started investing in mobile home parks, self-storage, apartments, just to name a few. By 2017, we started seeing some indicators in the market. 2018, we really decided to hone down on recession-resistant commercial real estate assets. We felt that they would be the best position for a potential correction. We focused on medium to long-term holds, typically investment durations of 5 or more years. And the idea there is to be able to weather a storm. We just continue to hold the asset, don't sell at the wrong time, keep earning cash flow. In 2019, we created our recession-resistant fund. We invested in 50 properties across 13 states and spread capital over more than 12,000 affordable housing units. We combined mobile home parks, apartments, and self-storage into that offering. And we're quite pleased. The fund's going very well. To date, we've caught up most of our preferred returns for our investors in the range of 8 to 10% annually. We've returned about 1/3 of their capital as well through property sales and refinances. Fast forward to the beginning of 2020 and the onset of the pandemic, we decided not to make any new investments. We paused new investments for about 6 to 8 months, just watching, waiting, learning, analyzing, trying to determine, is there going to be distress in the market? Are tenants going to stay and pay? And we found and felt by Q3 that the opposite was true. We started focusing more on shorter term investments. We added to our investment criteria 1 to 3 year short-term holds, really to take advantage of what the market was giving us, which was very rapid price and rent growth through proven value add renovations and natural market appreciation. And we've been saying it for a while that window of opportunity was going to be short. And we think today that it's most likely closed. We're not planning to do very many more, if any, more short-term investments. The real reason for us is just those deals have gotten riskier. The cash flow has basically gone to zero while we hold, and they're just more traditional flips, a lot of them with negative cash flow. And so outside of our comfort zone, to say the least. Okay, so today and looking forward, what are we planning to do? We're going to continue and again focus on lower risk, recession-resistant investments with an emphasis on affordable housing, which we find to be one of the best hedges against inflation today. As Dan noted, if we're not investing, we're losing money to inflation. And so we find that this sector has and continues to have the highest demand in history from residents who we rent units to, and to investors, who we're going to sell the assets to. So how we're going to do this, we're going to ensure that we're buying right with a attractive cost basis, with a medium to long-term business plan to hold, with a lot of focus on cash flow and predominantly 5+ year investment duration. We're always going to be consistently focusing on conservative underwriting, cap rate expansion, fixed rate debt, lower leverage. We were looking at a deal last week in Austin, Texas, 50% loan to value. So this is happening as we speak, and we welcome, more conservative underwriting. And we really want to ensure that post-renovation rents are affordable for the local market. And so that is a formula that we use. Typically, we're looking at 2 bedrooms, post-renovation rent between $1,000 to $1,500 a month. We're also focusing on higher quality properties that have attractive amenities, pools, playgrounds, gyms, dog parks, in locations with high demand and low supply in growth markets. And so we're focusing less on tertiary markets, which we think will be more volatile in the months and quarters and potential years ahead. And we're going to continue to partner with best operators in their class who have stellar track records and performing through multiple cycles. And lastly, we're going to identify and share unique niche opportunities that are recession resistant from our view, and which also still provide very attractive returns. So with that, I think I will pause and let's answer some questions and open it up to Q&A.
Hey, Mark, first question we have here is, what are the risks of getting in at quote unquote a market top in multifamily syndications? How do you plan on navigating the next several years?
Sure. Yeah, good question. So we've been cognizant of high asset pricing for the past 3 to 4 years, if not longer. Again, we ensure that we're buying right and that we have to just be really excited about an investment, or we're just not going to do it, right? And so I say this a lot, but we want to make sure that we're setting ourselves up to win, to meet or beat the projected returns. And there's a lot of deals now that just, we don't have that conviction around them, so we'll pass. Now, looking forward, let's extrapolate on what could happen, right? Let's just say there's deep discounts out there. We'll take advantage of those and, of course, negotiate pricing down if that is available. We have not seen that yet. We continue to see a lot of demand from other investor groups for assets. Now, if some of the fundamentals change, for example, if we see an increase in supply or a drop in demand or a reduction in occupancy or lack of buyers, we have no problem just pausing and not investing until we get back to conviction and have a clearer picture of the market and price stabilization. So if rent growth stalls again, or vacancy increases, those are some of the things that would cause us to kind of wait and see. If there's distress in the market, again, none of that at this point by any stretch of the imagination. And again, for us, we're just going to start continuously sharing opportunities that we think are unique. They have to have something special and recession resistance, again, where we have conviction around the main goal that they're going to continue to perform.
Next question, what types of opportunities are you finding attractive right now?
Sure. Well, we still look at about 10 to 20 deals a month. We invested in about 10 last year. I think that number this year is going to be lower, probably around 5, so maybe half, as more and more opportunities just don't meet our investment criteria, usually due to high risk today. And so it's just a filtration process. We're basically trying to select what we think are special deals today. There has to be something unique about it, as I keep saying. So what comes to mind, our current multifamily portfolio offering so many reasons, but we just feel it's one of the best investments we've seen in a long time. It really checks, all of our boxes, and you can access those details. I think there's the login button on our website, or emailing us. We're also looking potentially at another opportunity zone investment this year. We'll see if that comes to fruition. Right now, we're also heavily involved in tax abatement opportunities, where, again, very niche specific strategy where our operators partner with the local city, and in turn, they're maintaining 50% of the units affordable. By definition, it's a formula. And in turn, there's no property taxes for 99 years. So this type of niche we find to be very attractive right now, provides investors with high going in cash flow in year one, and lower risk. And so those are, I guess, some of the opportunities that we're finding attractive today.
Thank you. Next question is, are you starting to see any signs of slow payment in any of your deals over the last month or two with the spike in gas, food, and other prices?
Was it slow payment?
Correct.
Got it. Yeah, not yet. We're anticipating that's going to be market dependent. We obviously track that pretty closely. Some markets, we haven't seen any signs of that slow down. Again, the unemployment rate is at all-time lows. And typically what we find is that with housing, that's usually what people tend to pay first, and they tend to cut other areas if they need to, when deciding, where to spend.
Have you thought about buying houses to rent? I guess that's referring to single family rentals.
Gosh, yeah, we used to do that a lot. We had a portfolio of around, 50 doors or so at one point in the Midwest. It's hard for me today to get excited about that, because the rent to price ratios in most markets are just not that attractive as what they were, 5, 7, 8 years ago. I think there's some merit there because you have a lot of demand for housing, to say the least. We've been discussing that for a while. But at the same time, we're not specifically focusing on that. That's that niche.
Question that was emailed to us earlier. What do you see as the most affected segment of society? I'll take this one.
Sure.
So historically speaking, inflation has acted as a regressive tax, and it hits the lower income workers harder. People living paycheck to paycheck tend to suffer the most. So it's probably going to be the most affected segment. The follow-up question to that is, what do you see as the strongest segment in a recession?
Yeah, I'll take that, Dan. I just have to say affordable housing. So mobile home parks and Class B workforce apartments in growth markets. That's specifically what we're focusing on. We think is the strongest segment for market volatility.
Okay. And with the current economy and potential housing bubble, I would think that it doesn't affect the housing for apartment as much as people, since people always need a place to live. Am I on the right track? Do you think the current situation would have any impact on the cash return and original IRR?
Okay. Yeah, I think for us, we've been conservatively underwriting our investments for many years. While the current investment environment doesn't really lend itself to significant outperformance, as we've seen and experienced in the past, I feel pretty confident that our original targets will be met because we had a lot of kind of conservative underwriting built in from day one. Most of our opportunities were expecting or building into our pro formas, cap rate expansion, interest rate expansion. None of this is really a big surprise. We've seen unprecedented growth over the last few years, and we've benefited from that. At the same time, we've always believed that, eventually the music's going to stop or at least slow down. And we think that that slowdown is probably coming soon. Some of it may be here, depending on asset class, depending on market. But at the end of the day, we're very confident in our original targets.
Yeah, just to piggyback on that, Mark kind of alluded to it earlier, but when we're underwriting a deal, generally we're looking at rent growth of 3 to 5%, right? And as we showed in the charts earlier, rent growth has been far in excess of that, even up to 20+% in some markets that we're invested in. So I think that a lot of these deals are, from a top line perspective, are way ahead at this point. So we feel pretty good about them.
Thanks, Dan. Yeah, I agree.
Okay, let's see. We still have a couple coming in. Are most of the tenants in the mobile home park investments owners with adjustable rate loans or fixed rate ones?
Good question. I'll say this, a lot of them may not even have loans. In the past, it's been hard to finance mobile home. And a lot of our operating partners will focus on a strategy where they're going to offer that home to the resident through a rent to own program or a lease option. And so there isn't actually even going to be debt on the property. For those that do have debt, Dan, do me a favor, just jot down who asked that question. Let me ask, I'm curious to see if there's, it's going to vary per market, per mobile home park, but I want to dive in a little further regarding what the terms are. I believe they're fixed, but let me check on that. I think you're muted, Dan.
Sure am. I don't see any other questions in the chat at this time.
Okay. Any other questions, guys? You go ahead and type them in. One thing, Dan, that I had an investor ask me that I just want to add some clarity to. I think the question was, are you seeing real estate pricing going down? And the answer that I'm having, and we've been tracking this for a while, of course, is it's asset class and location dependent, right? That's a general question. And so, malls, office, some retail, some lodging, all different types of sectors that we don't get involved in. But on a macro level, I think it's probably safe to assume that we've seen some pricing adjustments. I think Green Street came out with a report just last week. It showed about 1 to 2% price adjustment for some of the asset classes that we focus in, apartments, mobile homes, self-storage, et cetera, really more as a national average. But there's so many investors seeking out these asset classes because they've performed so well and remained resilient through a lot of uncertainty that we've faced. And so they've also proven to be great inflation hedges. So we just find them to be, as investors, maybe a little biased, but one of the best places to invest today, all things considered. Now, looking at location, I think is really important and critical. Tertiary and rural markets, I believe, are going to see higher price adjustments. Maybe have already started from some of the data and folks we've talked to. They're seeing pricing adjustments in less desirable locations. While more secondary growth markets, where there's significant demand, lack of supply, and a lot of jobs, they're going to fare much better. And maybe to add some more context there, one of our operating partners, I think just earlier this week, probably on Tuesday, we were talking, and they're noting that in Phoenix, they've got, and Phoenix has been one of the fastest growing markets in the country for many years, but they've got, a lot of properties there, and they've been looking to sell and listing several of them. So it's a good gauge on the market, right? Well, who's showing up? How many people? They used to have about 25 buyers putting offers in on properties, and that number is now down to probably between half a dozen to 10. And so there's less buyers, but they're still getting very attractive multiple offers with a good, healthy demand from buyers. So again, it's really asset and location dependent. We've always been underwriting cap rate expansion. So a slowdown, again, has been somewhat expected from our view.
Another question came in. So what made you think the window of opportunity has closed? Was it due to rising interest rates? Basically, what you shared seemed pretty positive. But, you explained the window for opportunity in apartments has closed. Just want to understand clearly.
I mean, they're probably going to be okay, those deals. They're probably going to do well, but they may not, right? And this is how we look at things, is what's the likelihood and the risk associated with earning and receiving the projected return. And to add as to some context to that window, 2 years ago, when we could invest into a shorter term deal, you would be able to get just about everything: low debt, immediate cash flow in the middle single digits starting year one, and a very high likelihood of beating the projected returns, right? Because of the market momentum, because of unprecedented rent growth, because of significant investor demand. Today, those same types of deals are going to be slower as far as appreciation goes. Most of it's underwritten to be forced appreciation, which means when you have an apartment unit that, let's say, it's not renovated and it's renting 2-bedroom for $800 a month, to force the appreciation when that tenant comes to renew, you can offer them another place to live in the building and then take that unit and renovate it, bring it up to market, and you might see that appreciation go up, anywhere from $200 to $600 in some markets, $700 in some markets today. That's forced appreciation. Now, if that tenant stays in that unit and they just renew to the market rate, you're now going to be seeing a lower appreciation. So because they're basically we're not renovating the unit, right? And so you're going to see more of a bring it up to market. And pros and cons with both strategies. But today, looking forward, when we talk about that window of opportunity essentially closing, we don't expect the natural appreciation, if that tenant stays, to be nearly as high as what we've experienced. We still think there's a little bit of time left for that, but we never underwrote to 10, 20% natural appreciation. We would always underwrite to, Dan, 3, 4, 5% natural appreciation. So you're able to beat your projections because the market was so strong. So I don't think that is something that we want to plan for or expect going forward. But really, it's the cost of debt is the big underlying factor here. Shorter term deals tend to, a lot of them have floating rate loans, which today are 6.5%. In growth markets with a cap rate of 3.2%, the math doesn't work. Yeah, you have negative cash flow each year. And I've looked at several of these deals in the last 2 months. And so what are you doing? You're basically flipping, right? You're flipping. There's no cash flow. So we used to get, high middle single digits in year one. That went down in the last year and a half to kind of lower single digits in year one. And now it's pretty much zero for the life of the investment. There's no cash flow, and it's actually producing negative cash flow, where the amount of income that the asset's producing doesn't cover all the expenses and the debt. So that is outside of our risk tolerance level, and that's why we feel that window has closed.
Yeah, just to kind of reiterate, we don't think the window is closed on all apartments, just those short-term flip type of structured deals.
Correct. Yeah, there's still plenty of great opportunities to be had, but we're shifting just very specifically, right? We're still focusing on affordable housing, just more with recession resistance in mind, and an asset that doesn't produce positive cash flow and it actually produces negative cash flow doesn't feel like a recession resistant move to me.
What's keeping you up at night these days?
Yeah. I think, lately we've just been spending a lot of time. I had an investor ask me this maybe last week on a call. Like, what are you focusing on? And that's essentially what's keeping me up at night too, is the market. What are we doing? What's the market doing? The market being the real estate market, the economy. I don't really follow the stock market at all, so that doesn't keep me up at night, but I'm sure it's keeping a lot of people up at night. But that's really what it is things are changing quickly. We want to keep our eye on the ball. We want to be ahead of the game. We want to make sure that we're making decisions today that we think we'll be very happy about in 6, 12, 18, 24 months from now. And so that's really what I spend a lot of my time thinking about.
Okay. And Phoenix has also seen a huge influx of new remote workers since 2020, bringing in higher salaries. Do you think the great reshuffle is nearing an end, or will it continue to reshape housing demand in different cities?
Gosh, good question. Yeah, that has been a heck of a trend that we've all essentially benefited from. You're seeing a lot of net in-migration for people with higher paying jobs. And what's happening is sometimes it's gentrification, where you have neighborhoods that are turning over, and other people are moving out too because they can't afford it. And so there's a lot of shifting going on. I don't think it's over. I think it's still happening. Part of the reason why I say that is because we continue to see a lot of unfilled jobs in the job market. You've got employment pretty high, to say the least, unemployment very low, and not enough workers. And so I think there's still a lot of people that are moving around and shuffling around, as he said, to figure out what might be a good path for them and their career. And a lot of times this question, Dan, I get is related to the demand for office as an investment. And we just don't invest in office. I think today it's just a high risk asset. I don't know where the long-term trends are going, but I don't see a lot of positive signs that there's going to be an increase in demand by any stretch of the imagination for office going forward.
Yeah. Okay, I think we're out of questions at this point.
Okay. Oh,
wait. I've been involved in a few motel projects. Basically, the company I'm working with has been purchasing motels and renovating them. As investors, we are getting good cash return, but we don't participate in appreciation. Have you considered that? I'll start on this one. So I've seen a couple, not motel renovations, but hotel conversions to apartments. So like some investors will buy extended stay or similar hotels, which has a decent infrastructure for converting rooms into essentially studio apartments, and renting those out. And I don't know, my opinion is the jury's still kind of out on those. Personally, I would like to see that there's actually a strong demand for those kind of units before jumping into that. But it's certainly a trend that is picking up speed. I don't know, Mark, what do you think?
yeah, I mean, just to chat about motels, we haven't spent a lot of time focusing on them. One main hurdle for me is you just have a transient resident base, right? They're for short term. You have less reliability of income because of that, right? It's not a permanent residence. So that's the main reason why I just, I haven't been too compelled to look at it. Similarly to, lodging, Airbnb, these kinds of strategies, while there's probably a lot of merit for them, we just find that the risk of lack of long-term income with residents versus more what we call users, we haven't found the reward to be there for taking that excess risk. Any more questions come in, Dan?
No, that's it.
Okay. Well, thank you everybody for joining us tonight. I hope you found it informative. If you have any questions, always reach out, and appreciate your time.
Thanks. Have a good night, everyone.
Thank you.